that you're going nowhere. Don't blame me for what you've done, because I know that you are having fun.
Welcome to the Clarified Realty Podcast, exposing the real estate secrets your agent doesn't want you to know. Here's your host, Tom Clary.
Don't you just walk away. That's when I'll say.
Welcome to the Clarified Realty Podcast. Thanks again for coming back. We are always grateful and we appreciate it. I'm Tom Clary, real estate agent for buyers and sellers in Los Angeles, California. Here with me is my sidekick / loan officer, Ron Bruno. Ron, how are we doing today?
I'm doing great, Tom. Thank you for asking.
Great. We have some really great guests with us today, and I'm so happy to have them. It's Cindy, Nasser and Michael Baz of PCV Murcor, and they're going to be taking us on an interesting guided tour into the somewhat misunderstood world of appraisals. What are they for? How are they done? And we'll get into that in just a minute or two, but we've got a few news stories that I wanted to talk about here at the top. And so, Ron, why don't you go ahead and start? We had another big news story come out of Washington today, didn't we?
Yeah, we certainly did. And it's more of a potential intervention with the new administration when it comes to the Dodd-Frank banking law.
Right. And this is something that I had actually brought up, I believe, during episode 7 when I was talking about the possible implications of a Trump presidency. And it was literally one of the things I had put on my list as I think it was on their target list, basically, that they were going to hit. And it looks like they actually decided to go after it.
That's right. And so just as a refresh, in 2010, there were 2 senators that put together a special law that was focused on the financial industry and really geared towards helping consumers, right? It was all focused on the consumers.
Right.
And
protecting them.
Exactly, protecting them.
Under the assumption that the whole crash sort of happened because of shenanigans happening backstage with all the, banks and, like that. So we need to protect you, the consumer.
That's right. So the 3 areas that are in the crosshairs, if you will, are number 1 is the Volcker Rule, and that restricts banks with taxpayer-backed deposits. So everyone remember TARP? Remember yeah, that was fun. So back in the day, there was TARP. So the government bailed out these particular financial institutions, and they said if you take money from TARP money, then you are prohibited from making proprietary trades based on the bank's own discretion. So basically, you have a bank, let's say Citi.
Right.
Citi can't trade on with their own discretion. There's
right.
an extra level of security or intervention with their own money.
That's kind of a safeguard.
Right. So. With Trump's background and his Wall Street buddies, that's probably the number 1 that's going to be on the chopping block. Right. They see it as unnecessary, and
it's regulation that basically is adding fees to them and different hurdles they have to overcome. They want a free economy and basically nothing put in front of them.
Exactly. The second is the CFPB, so the Consumer Financial Protection Bureau, which really it certainly falls into my sphere from a lender and it also is in the world of credit cards, right? So what now
this is Elizabeth Warren's department, isn't it? Correct?
Well, it's not necessarily her department per se, but she's certainly on that. Yeah, she's on that
She's
committee.
mostly related to it.
Yes.
She's most closely related to
yes
it.
Yes. And this one is going to, what I'm reading and what I'm seeing is going to be the hardest to do anything with, because there's actually some good things that came about with TRID. I mean, some people, they say that TRID stands for the reason I drink, but, the TILA Respite Integrated Disclosures Act, having your clients understand and being able to put together a document where they understand what the costs of the loan are and what the cost of the transaction and what their rate is at the beginning and the end of the loan, that's not a bad thing.
No.
Right? So I've personally always endorsed TRID, and I've endorsed that side of it. I think, what I've seen is, they might fire the director, Richard Cordroy. That might be something he does.
Yeah.
But I think if you really get into it, if there's anything that screams, just blatant loose regulation for the sake of it.
Wild West.
Right. It's going to have some major pushback. And
Right.
I think Trump has enough of battles that he's going to fight.
Yeah, I think it's going to be a big fight
Right.
back on the other way. Now, whether or not they have the power to, of course, do anything about it, that's another thing entirely.
Exactly.
But we're not seeing any kind of, other than the possibility of kind of tangentially raising TRID or those kind of things, nothing really that's going to impact the real estate market.
Not that we've seen. Not that I can foresee. But then again, as we mentioned the last time we had the podcast, everything's up for grabs.
Everything is so totally still up for grabs. Now it seems silly that we're saying this only 2 weeks into the administration, but at the same point, you would think, well, most administrations it takes months in order to get
everyone talks about what's your 100-day plan. I think Trump's going to do it in 10.
Yeah, all right.
So he's going to shorten his window.
He heard the starter's pistol, and basically he's running outside of the stadium now and going down the street. So
exactly.
Yeah. Well, listen, we're going to keep our eyes open to see if this makes a move into something that really kind of affects buyers or sellers. But right now, I'm going to say a tentative. We'll just kind of put this on the back burner and see. Yeah, don't you think?
Yeah, I think so. I mean, the third one is the fiduciary rule, right?
Oh, right.
So that's important when it comes to financial advisors. So I have a lot of friends that are I used to be a financial advisor, and what the CFP, what Dodd-Frank did was they instituted a fiduciary rule, which required financial advisors to act in the best interest of their clients, which is shocking.
Why would you do that?
Why wouldn't they do that?
Right.
But it used to be the suitability rule, which just meant that, you sound like you should buy this in particular instrument. I don't know if I'd do it, but you fit the bill, so I'm going to go ahead and sell it to you. Well, now they have a fiduciary rule where they actually legally bind a financial advisor in putting themselves in the shoes of the client, and it primarily affects retirement accounts.
Right.
So,
but once again, not real estate directly related. So.
Nope.
All right. Well, let's move on. And the next item on the news list was. It's actually not really a news item, but something that Ron and I have been hearing a bit more about out there in the field, and I think it's time to kind of talk about it. And why don't you go ahead and Ron, before we get too deeply into it, and just go ahead and kind of explain what we're kind of seeing.
Sure. So what we're talking about are HELOCs. Right, and HELOCs can be your best friend, especially when rates are low.
Home equity line of credit.
Thank you, Tom. Mm-hmm. Home equity line of credit. And these are loans that are in addition to your primary loan, right? So in the past, we've talked about structuring a loan where you can put down 20% and still not pay mortgage insurance. How you do that is you have one loan that is at 80 loan to value, and then you put down 10%, and then the other 10% you're able to get a home equity line of credit that covers that. Now, home equity lines of credit, they are typically interest only, so you're only paying based on the prevailing interest rate. So it's not an amortized payment,
right?
And it's based on the balance. Now that balance resets and the rate resets on a monthly basis. So during the, I guess, since the recession, HELOCs have really helped people because rates have been super low,
right,
and people are paying lower amounts on their HELOC, and all is well. Well, it's interesting because now with rates climbing and the big shock, my phone is ringing for people that have an existing HELOC. And the challenge they're having is that, number one, they just saw that their interest rate and their payment has gone up because interest rates have gone up. So instead of it being 5.25%, maybe it's 6% now. And they're like, ooh, my HELOC went up by $20. That's interesting. But the biggest mark that I would recommend that people focus on is know how long that fixed period is for your HELOC.
Right.
Because the way that most HELOCs are structured, the ones that that we offer here, is you have a HELOC where for the first 10 years it's interest only and it's based on the balance, and it's interest only and it resets every single month. It's good for 10 years. After that 10th year, it's amortized, the rest of that balance, over 20 years.
Right.
So basically what you're doing is you're taking, so I'll give you an example, $100,000 HELOC at 5.5%, interest only is $448, okay? So you then take that same HELOC and you amortize it over 20 years, and now you're in the 600s, right? So it's shot up.
Right.
But what if interest rates go up at the same time?
Yeah.
Now
Which
you're looking,
highly probable nowadays.
Yeah, so even a 2% increase in that interest rate, now you're looking at an $800 monthly payment. And where it gets really, really bad, that's only a $100,000 balance. I was talking to somebody the other day. He has an $800,000 HELOC. His is at 10%. And it just amortized over a 15-year period.
Oh my Lord!
So he's got a little bit of a financial weapon of mass destruction or whatever.
He's sweating a bit.
So what I encourage our listeners, if you have a HELOC, it doesn't mean that you need to panic or anything else, but you should know what your fixed period is, when does it end, and you should also know what are the prevailing interest rates that are there. And a HELOC is really it's a bridge, right? It's just designed to get you in. So it's not a long-term solution.
Right. Well, this is something that I've been hearing about. It's something that's been bubbling up from some of the big wigs in the industry, like Gary Keller of Keller Williams. And I'm just hearing about it a lot around the desks at my brokerage. There's this sort of thing like, hey, there's a big sea change coming up, and we're about to see a lot more foreclosures and REOs coming up, and it's interesting. It's one of those things where it seems like all the facts are there, like logically, you can make the leap that we're going to, see a sort of a dip in the market, but I'm not convinced. A couple of things. I did a little research, and I took a look at the S&P Experian Second Mortgage Default Index, which is basically gauges. It's kind of like a graph that shows defaults on mortgages like HELOCs, which are the second mortgages for the most part. And I'm not seeing a huge spike at all. Actually, strangely so. I actually saw there was a slight rise in November. But I think a lot of that could be explained by people staying on the sidelines during the election. I know a lot of my potential buyers were saying that they wanted to put everything on pause until things shook out. So a lot of folks were staying out of the market. So less buyers were looking for houses. More houses that are on the edge of default can't sell. Hence, they go into default. So, but then you look at the December and January, and the graph just goes right back down to going downward. So that's one thing. I'm still not seeing a spike in defaults. I think there might be a lot of people getting the right idea and going to see Ron about a refi or somehow fixing this issue, but defaulting, not yet. And by the way, let me reiterate, if you do have a HELOC about to reset to start, paying principal and interest and what Ron was just talking about, you should have been on the phone with him last week. You really shouldn't be pausing on this at all. It's something you should really be finding out what's going on so that you are well educated and you can make a good decision. But just take care of it soon. That's really what I'm kind of saying. But in terms of the entire market, real estate market as a whole, I'm putting this in the wait and see category. I've told you in my commandments in episode 1, if I see a crash, I will definitely let you know, even if it hurts me. But I'm not seeing one yet here. But here's the deal. I don't think these guys are seeing the forest through all the trees. There's a real psychoeconomic issue that is not really being considered here. There's still people out there licking their wounds from the crash. They're scared of their own shadows when it comes to real estate. The concept of the quote-unquote property ladder has sort of become obsolete. Folks are staying in their homes a lot longer. They're not taking a step up the first time they have a chance because of this, because they're so scared still. We're still seeing just a trickle of inventory coming back out on the market. I think prices are going to stay elevated for the time being, which will allow enough equity for these folks to kind of exit gracefully from the HELOCs if they can before they turn bad. If it turns bad, I don't think it's going to be a 2008, 2009 bad. That being, hold on, let me get that. But let me just say, if interest rates spike too sharply, then all bets are off. I think that could very well change this. So in terms of buyers and sellers, buyers, I'm sorry, I don't think you're going to get a huge discount that you think you're going to get in 6 to 12 months if you wait. And even if you do, anything you save will probably just be canceled out by rising interest rates. And if you're a seller, if you're thinking about coming out on the market, I would really be thinking about it harder. But I will say this, forecasts are saying that we're going to see about an 8% rise in home values over the next year here in California. But if what folks are saying about the HELOCs come true, you'll be happy you had your ducks in a row. So I'm putting this in the wait and see file. No need to panic. No need to get excited. If we see something coming down the road, we'll definitely let you know. But Ron, you had something that you wanted to.
I was going to say, I think it's very premature in terms of any rise of interest rates affecting a default. Primarily because if you default on a HELOC, you're in danger of losing your home. Right. So that's number one. Number two, I mean, rates have only gone up in the past 2 months. Right. So I think it is very premature, and I think what a lot of people also, it's just making good financial decisions.
Yeah.
And if you have a first loan, and then you have a HELOC, a lot of people are consolidating, right? So they're just putting first loan and the second loan together and getting one loan rate for 30-year fixed and then be done with it. And they're happy with that.
Right. And I just I'm going also off of, literally had a conversation with another agent the other day that said, I'm going to make a killing in 6 months because all these things are going to be defaulting and foreclosing and all that. I don't see it happening. I think they're drinking a Kool-Aid that somebody is bought wholesale, basically. So, all right. Well, there you go. Okay, great. Well, that's the end of our news. I want to start with our conversation with our guests today. It's Cindy Nasser and Michael Baz. Cindy is a senior vice president of operations at PCV Murcor Real Estate Services. You've been there almost 10 years, right?
Yes, May will be 10 years.
Wow, that's a while, And you won a really amazing award recently, didn't you? It was the Housing Wire Insiders Award.
Yes.
That's fantastic, and it basically says you're the go-to person there.
Yes.
She says as she puffs out her chest and says proudly, "Yeah." So fantastic, and we're also here with Mike Baz, and we would be the quality assurance.
Yeah, I'm in the quality assurance group, and I mainly focus on escalations. So I'm the bridge between the appraiser and the lender.
Great. Good.
He's our firefighter.
Very good. And so basically what I want to kind of just start off with is a basic introduction to you guys. How did you get involved in doing appraisals first, and kind of like what your roles are there? I mean, so why don't we start with Cindy? You can go ahead and talk about how did you get into this thing in the first place?
I got a phone call about 10 years ago. I was making dinner. And my ex-husband at the time came down and said, there's somebody on the phone named Rich that wants to talk to you. I said, I don't know anybody named Rich. I don't want to talk to him. Turned out it was a recruiter. I was working at Yahoo at the time.
Oh, wow.
And prior to that, I was at B of A and DirecTV, and all in ops and call centers and really all about efficiencies. And PCV's been around for 35 years.
Wow.
And at that point, they were 20-something years old. They had gone through 5 years of consecutive growth and really needed to tighten up their operations.
Right.
I wasn't looking for a job. I said, I haven't interviewed for a while. It can't hurt. And so I showed up for the interview, and they made me an offer, as a godfather would say, an offer I could not refuse. So I went and joined. I didn't even know what an appraisal was.
Right. It's not, unfortunately, it's not, a lot of people don't know necessarily what it is.
It's not a sexy industry that you read about unless you're actually
not a lot of movie
to buy
stars.
a home.
Right.
So I did some research. I had enough understanding to get through the interview, and now 10 years later, I know more than I ever wanted to. And luckily, we have a lot of expertise internally. A lot of our staff on the QC side are all licensed appraisers.
Right.
So they've taught me a lot. I know the lingo.
Yeah.
In the last 5 years, Dodd-Frank has turned our industry upside down because we were never legislated or regulated, and we are now.
Right.
So that's completely changed our industry.
Before we get a little deeper in this, so explain exactly what PCV does, and so that kind of the audience understands that it's not just necessarily they're not just appraisers, but they're kind of the intermediary between the banks and the appraisers, correct?
Yes. So we're an appraisal management company, and there's an understanding in the industry that we were just born when HVCC came out through the Attorney General in New York, made that agreement. AMCs were around way before then. And what an appraisal management company does is they're basically the broker between the lender and the appraiser.
Right.
So, and we're nationwide.
Right.
So oftentimes, it's too costly for a bank to have staff appraisers or to have a department that orders appraisals and manages the pipeline.
Right.
So the lender sends us an order and we find an appraiser in that particular market to fulfill that appraisal.
Right.
So, oftentimes people are like, well, the lender's your customer, and not really. Ultimately, our customer is the borrower, because our role is to protect their interest as well as the bank's interest in their risk.
Right.
So if we get an appraisal, we have appraisers that are looking at, they can tell if there's something not right within the appraisal, if there's something wrong with the property that needs to be addressed, and ultimately to make sure that the borrower is not getting a value that they shouldn't be getting. Right.
Right.
So our role is to, just like home inspectors, just like AAA. AAA doesn't employ the tow truck drivers, right? They have a huge network of drivers. And so when you call AAA, they dispatch and they find, whoever the best one is in that area, and there they come.
Right.
So same exact thing with an AMC.
Got it. And Mike, so you're so in terms of how did you get started at PCV, and what's what are your main job responsibilities?
I actually am from Southern California, but I was working in South Florida. I was managing a marina.
Oh, wow.
In a prior life.
Wait a minute, you were managing a marina in Florida, and you came here?
Well, Hurricane Andrew drove me out of Florida.
Okay. That would sometimes do it. Okay, got it.
So I was managing a marina there, and I was taking real estate courses. The one that made the most sense and just worked the way my brain worked was the appraisal courses. Came back, got my appraisal license, Southern California, met my wife in South Florida, brought her back with me.
Okay. At least you decided to come with you. That's always a positive.
That's a good start. And opened up my appraisal business here. I work. It's very challenging to become an appraiser. It takes a lot of time, a lot of experience, a lot of education to become an appraiser.
Right.
Back then, it was a little bit easier.
Yeah, and it's interesting. We're going to kind of touch on this a little bit later, but we're also seeing an issue of a shortage of appraisers because it's so kind of there's a high bar that you need to be able to get over in order to really be useful.
Yeah, there's really a lot of dynamics that go into that. A couple big factors are you need a 4-year degree to become an appraiser, and now there's not a lot of parents that want to spend $40,000, $50,000 a year to send their kid out to school to come back and say, "Hey, Dad, I want to become an appraiser."
Right.
So that is one problem. The other problems with it is the population of appraisers is becoming quite old.
Right. Well, actually, why don't we just go ahead and talk about it? Because that's really what we were talking. We discussed this on a previous podcast, and that it's the average age was 55. Okay. Wow, it's raised even higher since then. So
just another fact to throw in: there's more appraisers over 70 in California than there is under 30.
Oh my Lord. Is that so? So, by the way, if you're not, for those of you that are tuning into this podcast, there is a real opportunity here. If you hear, there is a need, and I'm going to rush out right now and start my own. I'm going to become an appraiser, for God's sake, if there's that much demand. Wow, that's insanity.
Yeah, it is.
And it's a little bit tougher for them to get up the ladders and walk around the houses and, you know? Yeah, right? Am I crazy?
I don't know if you're crazy.
No, I am crazy. Well, we'll just cut to the chase on that one. Yes, I am crazy, but no reason to even go deeper into that. But okay, well then, so your role though here at PCV, not here at PCV because we're not at PCV, but at PCV is what? Like, what do you do with the appraisers?
So after the report's delivered to the lender,
right.
My job would be to help the lender get that loan satisfactory through their underwriting.
Uh-huh.
A lot of times what that might mean is that there's something in the report that is causing the loan not to smoothly progress.
Got it.
It would come back to my group, and my group would be the bridge that works with the appraiser.
Got it.
We would be the ones to try to get the information out to the appraiser in really an independent manner.
Mm-hmm.
It doesn't matter to us one way or the other what the value of the report is, let's say. We just want the report to come back satisfactorily that meets underwriting standards of the lender.
Right. Got it.
My team does that.
Right. So you're basically you're the appraiser of the appraisers almost. You're really watching them and making sure that they're filling in the blanks, doing what they need to do the way they're supposed to do it.
Yeah. We have a lot of value adds at our company. We have a few things that a lot of other companies that don't do. When I was in the field, I've been an appraiser for 25 years. It used to be that we would meet for coffee in the morning and we would talk about our appraisal problems. Somebody had a problem with a report, they didn't really know how to deal with it. Somebody there would offer advice and may even go to the inspection with them. That's all gone. That network doesn't exist anymore.
Right.
What PCV does is we have a team there that the appraisers can actually call in with appraisal problems, and we will help walk them through as best we can whatever that appraisal problem is.
Got it.
You've got a partial interest cattle ranch. They don't come up a lot. We have people there that could help you work through that process satisfactorily. So my team does a lot of that mentoring with we don't really mentor because they're not our employees, but we're there as a sounding board for them.
Great. And and I want to take this back to one of my commandments at the very beginning. And I told you guys in episode 1 that I'm going to bring on experts that are the best in the industry. And when you have someone who's actually the appraiser of appraisers, there's no doubting the expertise that's involved here. So we're so lucky to have you here, Mike, and I really appreciate you coming by.
Thanks. Great to be here.
So let's talk briefly about why appraisals. What the heck are they, and what is it for? The most basic sense, basically the appraisals come. There's an appraisal contingency that comes 17 days into the transaction. In general, you can always have them removed, but I don't recommend that, and we'll discuss that later. But basically, you're checking to make sure the lenders want to make sure that if the house is, they're paying $600,000 for the house, they want to make sure that the house is worth $600,000. It's most basic. That's really what we're talking about here. There's all sorts of other ways that we look at in terms of income properties and stuff like that, and we'll kind of briefly talk about that later, the different types of appraisals. But in terms of buying or selling a house, that's really the conversation that you have. Is the house worth what we're paying for it? The market is saying this, you paid X. Is X too much? Is X too little? So why don't we go kind of briefly into the first step is who gets involved with hiring the appraiser? I'm assuming it is the lender, correct?
So the lender, depending on their model, they will go to an AMC, and most lenders have multiple AMC relationships, and they do a round robin and pick AMCs for different reasons. When the order comes to us, we then have to pick the appraiser to complete that report. So we have a lot of information on the appraiser. We know how they perform.
Right.
We know what special skill sets they have. So for example, in California, you have a lot of high value jumbo stuff. We do a lot of private banking business, which requires a different type of appraiser, somebody that has excellent customer service skills. It really understands what value means in a high value property, right? So our job is to make sure that we find the best suited appraiser to complete the appraisal for that property.
Interesting.
So it's our responsibility to pick the appraiser to actually do the appraisal. The lender is not involved in that, and that's one thing that Dodd-Frank put into law is that nobody that has a financial interest in that loan can select the appraiser. Right? Because a lot of the media and everything around the crash in 2008 and 2009 was that there was a lot of collusion between loan
can you help me out and get this kind of, let's push this through.
Exactly, right? So the other thing that we do, Mike's team is there to speak to the appraiser and help guide them through some of the most complex appraisal issues. Our job is to make sure that the customer is taken care of and that they don't ever cross the line, right? So one of the other value adds that we bring is that, this is a very emotional transaction, not just for the buyer, the seller, but the loan officer, right?
Sure.
So we understand that there are commissions that, people don't get paid. We do a lot of mortgage broker business. We understand that those are all independent small business owners and that they rely on that income at the end of the month, right? So we're not here to kill the deal.
Right.
We're here to protect everybody's interest. And so we help guide the loan officers and the brokers how to handle value appeals, how to address certain issues. Oftentimes a borrower thinks that something is worth more than it truly is in the market, right?
Right.
So there's some folks that overbuild their home in an area where no other house looks like it, and no one else wants to buy it.
Very familiar with that,
right?
Absolutely.
So, but for the seller, it's a very emotional thing, or if they're refining, right? And they want to get more money out of it, and you try to explain to them that 80s style kitchen doesn't conform to the market, right? So the value that you spent or the value that you think it has isn't there.
Right.
And so our job is to also help educate the loan officer and the broker to help guide the customer through that and understand why.
A silly question. When you brought up the kind of idea of this is the best appraiser for that exact property kind of, and that, I mean, is it, I don't know why this kind of popped in my head. Is it kind of like an Uber kind of thing where literally there's like, they get 5 stars or 4-star kind of thing? I mean, is there a qualitative?
Yes, we have proprietary ratings for each of our appraisers.
Wow.
So, one of the most important things to loan officers is timeliness.
Sure. 100%.
More than anything,
agents too,
right? More than anything, everybody's like, I need that back in 5 days.
Yeah.
In certain markets, really rural areas, you can't control that it's going to take 15, 20 days. You just can't.
No.
Right?
Right.
But what you are aiming for is that appraiser honors their commitment.
Right.
So when you tell me it's 15 days, that's 15 days, not 25.
Correct.
Right? And that's something that we measure and really prioritize because it's a customer service issue. Right? And it's extremely critical, as you all know.
I have definitely heard of just agents literally sitting on their the pins and needles because they still haven't heard from the appraiser, and it's and when I hear about the shortage of appraisers and the backlog that must exist out there, it doesn't it makes total sense that this is an issue that's starting to kind of rear its ugly head. Correct? Yeah,
and it's market driven, so there's always this hysteria, right? So we had one of the craziest summer purchase seasons
last summer.
I don't know how many years.
Right.
There was a very high demand in certain markets. Certain states are just gangbusters.
Right.
So right now, there's plenty of appraisers in those areas because the demand is low.
Got it.
Right? So in some areas, there is truly a shortage. In other areas, it's basic economics, supply and demand. And you can't just go get 30 more appraisers and throw them out
just
there,
throw them
right?
at it. Yeah.
So part of the challenge that we have is having the lender set realistic expectations as well, right? So in certain markets where that the appraisal is literally going to take 30 to 45 days, that the expectation is set, it's going to take 45 days.
Right.
And not sell 7 days.
No, we can do this.
10 days, right?
Oh yeah, we got it. Yeah, absolutely.
Yep.
So, so now that we're talking about this kind of, we're out there looking for potential new appraisers. I mean, but what is you mentioned the 4-year college? What else can really? What do they have to go through in order to get trained, or seasoned, so that we can have the lender has confidence that they're going to create an appraisal that is going to be counted on.
So there's 4 different, let's use California as best example. There's 4 different licenses in California. You start out with a trainee's license.
Right.
You work under a supervisor. You can't do a report on your own. I think the trainee license is 150 hours of appraisal education. Mm-hmm. And it with each level of licensing, there's a presumption that you have a higher level of appraisal experience. It goes from trainee to licensed appraiser, certified residential, and certified general. The certified levels would be the most experience in the residential and in the commercial market. It takes about 2,500 hours of actual field experience before you're ready to go off and do an appraisal.
That is a lot of time.
Well, and you have to also consider that the appraisers are in a position now of having to train their competition.
Yeah.
So a lot of people don't want to be the supervisor
fascinating.
and bring on a trainee because they're effectively in that market.
Right.
I'm the big fish in the market. There's only 3 of us out here. Why do I want to bring more
Why would I bring somebody else
into the market? Because as Cindy said, it's a matter of supply and demand.
Wow.
So appraisers in a lot of ways control the supply of appraisers. So right now, the industry as a whole is struggling with alternatives to get folks licensed without having to be under the thumb of a certified appraiser and giving them the field experience. The other thing to note is that every state has different regulations on how they license an appraiser.
Right, of course.
And the other thing are investor guidelines, which is another hurdle in a lot of cases because some lenders do not allow a trainee to inspect without the licensed appraiser. So if I have a class of trainees that need training and I've got one supervisor appraiser, it's not realistic that they're going to be able to do a whole lot of work
Right.
if they have to go
Of
on
course.
every inspection with them.
Absolutely. Yeah.
So right now it's become a congressional issue. So
Jesus.
they're trying to address how to change the requirements. You know, like so many things, there was overcorrection with Dodd-Frank and
Right.
the crash.
Right.
They didn't have to have a 4-year college degree up
Right.
until 2 years ago. The requirement went into place because of everything that happened. They said, oh, well, they need more education.
Yeah.
So-
but more education. I mean, look, my 2 cents, and I'm a college graduate, and God bless, and everybody out there who's a college graduate and all that. But getting out there and getting in the field, there's a lot to be said for just grinding and hustling and learning it out there on the job. If
Right.
that's what you're gonna, look, it's definitely something that's needed out there, and we got to get these people out here, and so got to do something to break this log jam.
Yep.
And so are there any kind of ideas in the industry in terms of talking about how that log jam can be broken?
Well, the good news is, I was going to defer to Cindy.
Okay,
on
great.
that.
Thank you very much.
But the good news is, many appraisers like myself become appraisers as a second career.
Right.
There's a lot of people that were engineers. I know a lot of attorneys.
Yeah.
Actors, musicians.
Yeah, right. And we're going to get to that actually, because I've heard something about that. But go ahead.
It's very often a second career,
Right.
And you will see those people moving over into the industry, and you'll see there's a lot of family businesses. I know that in the last 2 years, the number of people taking tests to become appraisers has actually increased.
Okay.
But it probably is a matter of it being too slow, really, to notice it at this point.
Well, and I guess there's got to be some sort of comfortability from the lender to have faith in this new kind of way of doing it, because they have to have faith that appraiser is going to be able to have enough education to do that job. Correct.
Yes.
Absolutely.
Yeah, right. All right. Well, we've kind of chatted about that. So why don't we move on to basically the what I like to every time when it comes to the different categories of what we go through during a transaction, I like to kind of break it down to the most kind of basic building blocks. And so why don't we go into just kind of a step by step, like literally you show up at the house. What is an appraisal, and what is it? What do you do along the way?
Well, an appraisal starts well before I'm going to show up at the house. So what would typically happen would be a company like us or a lender is going to engage you, and at that time you're going to get an engagement letter. The engagement letter usually spells out what that particular lender or that loan program is going to require of the appraiser. Some of the engagement letters can be quite granular. There might be a lot of you might see a lot of conditions with one lender that you don't see with the other. Mm-hmm. All of that's incorporated into your research. Really, the 4 elements of it is prior to the inspection, you're going to gather all of your information. You're going to define the neighborhood. You're going to look at Google Earth.
What is define? Go a little bit deeper into what is define the neighborhood.
Well, there's very specific neighborhoods. As an example, a school district may define a particular neighborhood. Okay. If you're to use Southern California as an example, La Cañada has a very well-known school district,
very
right?
Well-known, yes.
It borders Montrose and Glendale.
Right.
You're probably going to see a property difference when you get into La Cañada versus Montrose or Glendale. That's not an insult to Montrose or Glendale, but the school district in La Cañada is, is a superior school district.
Right.
So you're going to define whatever that market neighborhood is, and you're going to try to search within that neighborhood for the best data that you can come up with. Sometimes you need to expand your market out farther, but the best comp is going to be generally going to be the most proximate comp.
Right.
So you're going to start your research. You're going to look at Google Maps. I'm looking at Google Maps because I want to see if there's anything around the subject that might be value influencing. If you're in the Hollywood Hills, the view is going to absolutely be value influencing. If you're located across from a freeway on-ramp or a cemetery, that's also probably going to be value influencing.
Right.
So I'm going to want to know that. I can't see that in my data. And that's one thing that's wrong with, there's a lot of talk about AVMs or automated valuation models. That's one problem with them. Zillow, as an example.
Right.
Zillow doesn't account for the location of the property. It doesn't know that you have a spectacular view of the city, as an example.
Right.
So we're going to look at Google Earth, and then we're going to start collecting our data.
Right.
We're going to try to pull...
I'm sorry to interrupt, but so you say that you literally, if a school district is, we've discussed this on previous podcasts about school districts, do you look at, is that house actually in that school district?
Yes.
So you for every house, or is it just...
No, you should have a pretty good idea of where those school districts are, and if you don't know, and if the school districts in that market are an influencer of value, you should find out.
Right.
As an appraiser.
Right. Because it does add to the value, I was
Yeah, and it's probably one of the more common value reconsiderations that you get from the borrower is, hey, I am in X school district, and it's a better school district than Y's school district.
Right.
We have a lot of experience here in the San Gabriel Valley, where we're at right now. There's a big difference from one school district to the next. Pasadena and South Pasadena, as an example.
Right.
So yeah, it's a big influencer.
So I'm sorry. So go ahead. You were saying,
Yeah. So we're going to collect our data. We're going to find our comparable data. I know that there's comparable is probably something that people understand, but what a comparable property is it would be a home that competes with the subject.
Right.
That would really be the way to boil it down to if that house is competing, if a buyer would look at that house as well as your house, that's a comparable property.
Right.
And then we're going to look at zoning. And from there, we've gathered our information. We probably know the comps we're going to use. And we're ready to go out and inspect the property.
You're ready to roll. You're ready to show up. Okay,
Right.
great. So you show up on the day of.
Right.
Now, in terms of, is there, let's say I'm a seller.
Yeah.
Is there anything I should be preparing beforehand? Or is there anything that is making my bed going to make a difference? That kind of stuff.
Well,
you know what I mean? Is there, if it's staged, if it's nice, does it make that much of a difference?
Theoretically, no. But it really depends on degrees, right?
Right.
It's hard to unring a bell. When a house makes a bad impression, we're not supposed to factor that in.
Right.
Things like housekeeping. But the reality of it is, to some effect, the house doesn't show as well.
They're human beings who are actually walking through this house.
That's correct.
And they're going to have opinions, and they're going to have a slant, even though they're supposed to be neutral and not supposed to have those kind of right. I mean, that's
nobody expects it to be perfect. God knows my house isn't perfect. But you should be mindful of some of the more egregious examples that I think that all of us that visit houses have seen. Chipped paint is, I think, a big one. Paint is very cheap.
Wow.
It's a very easy way for a homeowner to spruce their house up, and they can do it for a can of paint and a weekend up on a ladder.
And it'd be something that basically gives it a little bit of a sheen that makes the appraiser go through and go, oh, check, and that's probably a little bit higher level value.
It just it helps with the overall
psychologically
overall appeal of the home. I would definitely declutter. I wouldn't forget the yards, mow your grass.
Right. So the mowing the grass also.
Well, you're taking photographs. So remember that, we're not making the decision on your loan. We're going to take the photographs. We're going to put them in the appraisal report, and the lender and the underwriter is going to look at them. Ultimately, the appraisal has to make sense to the underwriter. If the appraiser is talking about how well the house is maintained, and the underwriter looks at the front view and sees the grass up to the knees, the music doesn't match the movie.
Right.
So, they're
out of sync.
Right. They're a little bit out of sync. So, I Bedrooms and bathrooms, if you're going to spend a lot of money, probably you're going to get the biggest bang for your buck.
Right.
But you really don't need to go there. You can do a lot of decluttering, small stuff, paint, and I think
Yeah.
that would be my recommendation.
Interesting. That's good to hear. That's the kind of solid, real world advice that is really helpful. So in terms of, now I know that, I in terms of when I know that an appraisal is about to happen, if I'm on the buy side, I say, that your agent shouldn't be there. Actually, you're kind of hoping that, the appraiser is going to see when it comes down to it, you want to pay as little for the house as you possibly can. That's the key, right? So if you want to hope that appraiser walks in and they're finding faults, you don't want to necessarily be the one pointing them out, but let them find them, and that's going to affect the valuation, right? If you're the sellers, make sure your seller's agent is there, because if there are any questions that an appraiser might possibly have, you want someone who's knowledgeable about the house to be able to answer them, correct?
Yeah, I would agree with that. There's a lot of appraisers that are a bit prickly about talking to the realtors at all.
Yeah.
However, there's absolutely nothing wrong with, I think, at inspection, the realtors talking to the appraiser. I think that's fine with most appraisers if you provide them comparable data.
I was about to ask you that, because that's something that's sort of a debate in terms of,
Yeah, I think Fannie Mae has a FAQ that is pretty persuasive that giving data to the appraiser doesn't impair the independence of the appraiser, right? It's just data. It's just another data point for the appraiser to analyze. Once you've given him that data, though, you give it to him impassionately and walk away and let the appraiser do what he will.
So don't try to create some sort of emotional impression on him.
I wouldn't even discuss value with him. I wouldn't go there.
Yeah.
Because it could also backfire, correct?
Well, Dodd-Frank legislation says that you cannot threaten or coerce an appraiser.
Okay, got it.
It violates appraiser independence, which is in Dodd-Frank.
Ah.
And that's what's widely misunderstood.
Got it.
So an appraiser thinks, well, you can't even talk to me, which
Right.
isn't true. That's not true.
Right.
Appraisers are expected to talk to what the appraisers in the industry refers to as market participants, right?
Right.
So if you're a real estate agent in that market and you're selling homes and you're aware of what that market is about, then you have relevant information, right? The minute that you start to threaten the appraiser or you start
Sure.
to apply pressure,
It's probably
that's
not looked too favorably upon, is it?
that's where the problem comes in. And so
Yeah.
we have a requirement, a legal requirement, and so does the appraiser,
Right.
to report anybody
Oh,
that
boy.
attempts to threaten, coerce,
Oh, boy.
influence.
Got it.
right? So a lot of lenders put guidelines out there, because I know a few. I've done presentations at a lot of real estate offices, and they were specifically told you cannot talk to the appraiser.
Oh, wow.
And that's because the only way they feel they can firewall
Yeah.
is by saying
And protect.
is
Got
you
it.
can't talk to them.
Wow.
So there is this misunderstanding, and a lot of the challenges that Mike deals with oftentimes is if a lender does send something that needs to be corrected in the report, the appraiser says, well, no, you're influencing me. You're violating appraiser independence. And that's not true.
Right.
And that's where the benefit of having the QC team and appraisers is
The
they can
intermediary.
they can talk the appraiser off the ledge because it's, peer to peer.
Right.
We know the law very well, right?
Right.
And so we can articulate it. And that's, again, where we can tell the loan officer and the mortgage broker, don't say that. Don't do that. Because as soon as you do, you're killing your own deal.
Right.
And that's what's really important for the loan officers to understand is that do not go there.
Right. Now, Ron, you have something that you want to kind of interject here.
Yeah, so in terms of guidance when we're doing value reconsideration, so let's say the appraisal comes in and there's some information and our borrower, and this happens a lot with refis, right? They think the property's worth X amount and they're getting their cash out, and all of a sudden it's valued lower, and they're like, what do you mean I have to pay an extra 0.25% because that's what that lender is asking for, or I can't take my the amount I wanted to take cash out. So what's interesting is, the immediate response is, well, that appraiser doesn't know what they're talking about, right? And you can't put in the AVM, the reconsideration of value. You can't say that this appraiser does not know what they're talking about. They don't know what they're doing, right? You can't say that.
Right.
It has to be factual.
Right.
So you have to provide certain comps that may not have been included.
Right.
And you have to make sure that they're within the 6-month, 12-month time frame.
Right.
And you also have to make sure that whatever you're putting in there, it can be validated by data.
Yeah, and
Right.
I want to get back to kind of we'll go back to that when we talk about challenges and stuff like that in terms of if for whatever reason it comes in under. But so let's before we get leave the process of the appraisal. So we're all done. Anything else you wanted to discuss in terms of that needs to be done there while you're at the
Well, we're going to
property?
measure the home, obviously,
yeah,
and that's another bone of contention. Often the home will be either smaller or larger upon
Right.
measurement than it is in the public record.
Right.
Generally, appraisers, if they're within 100 square feet, generally they're not concerned about the differences in square footage.
Right.
If it's larger than that, then the appraiser has to do a little due diligence, find out if there's been an addition added to the home. I would always recommend the borrowers up front, if they have some sort of conversion or addition, they should discuss it with their loan agent up front and let their loan agent anticipate that
Right.
for when the appraiser goes out to the property. For us, we appreciate that even coming over. A lot of times it'll come over in the notes where we'll be aware of that, and it makes it a lot easier for us to work through the process with the appraiser. And then the appraiser is going to take a lot of photographs. Anything that's value influencing, he's going to take the photograph. If it has a view, he's going to take a photograph. If there's a health and safety problem with the home, maybe it has window bars, the appraiser can't find releases
Right,
on it.
right.
He's going to take a photograph of it. And then the GSE has a requirement for a particular number of photos for each property to be taken, living rooms, kitchens, bathrooms.
Got it.
As an example.
Interesting. Okay, great.
So we've done our inspection. We're
Right.
done. We're going to go back to our office now, and we're going to work the report up.
Now, is any of that automated?
Not really. The data can be somewhat automated. You
Yeah.
can set up parameters, and the data will pull around certain parameters.
But there's
and-
no kind of crunching of numbers and value in order to create the valuation. It's
Well,
all just a guy sitting
There's regression tools. There are a lot of tools that appraisers can use. Most don't use them.
Really?
Most appraisers don't use them, and they really shouldn't use them. Averaging isn't really a independent valuation.
Got
right?
it. Right.
There's a lot of data, and you can torture data to say anything you want it
Sure.
to say, right?
Absolutely.
So the appraisers are supposed to be doing an analysis.
right.
And the data can be it can be a tool for them to use, but it can't be the basis of the appraisal.
Got it. Okay, great. So, and then you basically deliver the appraisal.
Right. We're going to go back. We're going to work up the report. We're going to deliver it to the client, but it isn't done yet.
Right.
Because now the client's got it, and it's got to pass underwriting.
Right, exactly.
So the collateral underwriter is going to run against the property on the lender's end. They're generally going to run it through an underwriter. Then they may go through a risk or a review department. Once it's gone through all that, if it's passed, then the appraiser's done. If there's issues, it's going to come back.
Yeah.
And it's going to come to a team like mine, and then we're going to do our best to try to remedy whatever the issue is with the appraiser.
Got it.
Big or small. A lot of times it's very small issues.
Right.
Contract changes.
Right.
Borrower name misspelled.
Right.
Those would be very common types, but there are more serious problems as well.
Sure. Okay, so then, so basically we're going to, the report is delivered. It is on target. It is under. It is over. Those are pretty much the choices, correct? I mean, no other options that I can think of, right? I think it pretty much covers the spectrum.
Under or over what?
In terms of under the list price of what
okay.
the purchase price,
Gotcha.
and basically what the lender wants to know that it's worth. So I want to go kind of do a little tangent here in terms of the contingencies and what that means in terms of the appraisal contingency. So contingencies, as we've discussed, are different little gates that you basically pass through as you go through the transaction, and basically basically, as you pass through them and you release them, you're closing that gate and you're making it so that you can't go backwards through the transaction. And one of those is the appraisal, which is at 17 days. So, and I will say right off the top of there are some deals, especially when it's really hot markets, they'll say, okay, will you come in non-contingent? Which what they're basically asking you is, are you going to come in and basically, no matter what the appraisal says, are you going to take this house? I dissuade my clients from going that way. If they have that comfortability, fantastic. But I always like to say that you probably want to take a second and think about that, because you're basically, if it comes back where you're paying $600,000 for the house and they say it's only worth $560,000, you've now overpaid $40,000 for the house in theory in the value of the house. So, and it's another way that you can also get out of the deal is should you need to later on. It's a little bit more difficult, but if you release that contingency, you're basically saying the last thing we've got is whether or not that loan gets approved. So let's say that the house is worth more than the house is worth what you're paying for it. That means you're okay. Let's release that contingency and we're moving on with the deal. Let's say that the house is worth more or less. Okay, so you get into the kind of situation where you have certain options. One of the options is going to be going back to the appraiser and having a conversation, correct? I mean, basically rediscussing it.
Yeah, absolutely. And the best way to do that, I think we talked a little earlier, is with data.
Yeah.
You can
showing up with comps, basically saying.
Really what you want to point out is any material error the appraiser made or what the appraiser might have missed.
Right.
And those are really the best ways to approach it. Most borrowers are pretty savvy about houses in their own neighborhood.
Right.
They played poker there. They've gone to a Christmas party there.
Right.
They really understand the houses in their neighborhood. Provide them to the appraiser. Maybe the appraiser missed them. Don't get hung up on small issues like the appraiser said that you had wood floors in a room where you actually have tile floors. That probably isn't going to be material, and it probably isn't going to make a big difference in the appraised value. What will make a difference in the appraised value is he just missed a comp. He or she just missed a really good comp in the neighborhood, or he missed the fact that you have a complete panoramic view in the back.
Right.
And he didn't weight it correctly, or he didn't give it proper consideration.
Right.
So I would really stay data driven. Don't throw in ad hominems. Don't threaten the appraiser's license because you're still trying to work through the process.
Of course.
And we have the ability sometimes to as an appraiser talking to another appraiser, say to him, look at the view in the back. Let me show you some.
Right.
Let me show you some sales that are selling with a view versus sales that are selling without a view.
Right.
And a lot of times that will be enough for the appraiser to say, okay, I'll take another look at the report. We don't have anything to do with the value, though, one way or the other. Whether we treat the report the same, whether they're under the value, they're over the value, or
Sure.
they come in at value.
It's a cut and dried thing for you guys.
Yeah, for us, it's data.
Yeah.
It's really just data.
Right.
I will add that the one thing that we do is that if the appraisal comes in under the purchase price, before we ever deliver it to the client, we're going to rip it apart to make sure that the value is supported.
Got it.
So we can't tell the appraiser you need to change the value, but if we read the appraisal and we don't understand how they arrived at that value or the numbers don't make sense.
Which really shows the value behind PCV. Is basically you guys, you're the stop guy. You kind of are the QC, for lack of a better word, of these appraisals.
Right.
And you can stop this before it even becomes a problem.
Right. So then, and the same is true if it comes in and it's extremely overvalued.
Right.
Right. Because then you should be concerned that maybe there's something else going on. So we will do our due diligence, everything. We will gather it and package it up and say, we QC'd this. Here are the things that we found, or the value is supported, et cetera, right? So we're just going to make sure that before we ever drop the bomb, as we like to say, that we've done everything we can up front to mitigate a lot of that.
Now, in terms of on the buyer side and the seller side and working with the agent, so let's say that the appraisal has come in under, let's say it is $590 instead of, $600. The loan is going to be, if it's going to get approved, they're only going to give you the $590 because that's what the valuation is saying. So you guys have to either make the seller and the buyer have to come together and agree to how they're going to deal with the issue of the extra $10,000. A lot of times it's kind of splitting the baby. A lot of times it happens where basically the seller goes, you know what, I'll reduce the price to $595. You guys come in with $1,000 basically, and everybody kind of it evens out and everybody's happy. So that's another way to basically, if you can't go back to the appraisers and get some sort of reconsideration of the report, then the only other alternative you have, other than basically getting out of the deal, is to work it out. And that's why it's also very important that you want to try and keep your relationship between the buyers as a buyer and with the seller as little adversarial as possible, because you never know when you're going to need that leverage. And until it gets down to the end of that the whole transaction, you guys want to try to stay together and work it out. That's always the best way. Ron?
So one of the things you want to be cognizant of is if, let's say, $600,000 is the purchase price and it comes in at $550. Well, if you were putting 40% down and now it's going to be based off of the $550, you're still fine, right? From being able to move forward with that loan. But let's say the lender requires 20%. Right, and you've reached your max.
Yeah.
Well, now if you can't put more money into the transaction,
right,
then that can be a big challenge.
Right.
Right. So you want to make sure that you have a little bit of buffer when it comes to your overall assets and closing costs, so that you're not completely up against that particular number and you have to do it. Right. So you want to make sure that you're prepared even before you enter into the transaction, that you have a little bit of buffer in there.
Right. And always, there's always the nuclear option where basically if it does not appraise, you get out. So, all right. So we're going to kind of, we're moving into basically, we're going to wrap this up now, but I wanted to briefly just kind of talk about, in terms of you guys were saying that it's very important to kind of pick the right appraiser for that specific property. Should you be suspicious if you start to hear like, this guy's coming in from Orange County or something like that? I mean, is it a valid concern?
No.
No, really?
Yes.
Okay.
This is one of my favorite topics. So let me give you an example. Our chief appraiser moved from Pennsylvania and has lived in Pasadena now for 2 years. He still has a license. He doesn't know diddly squat about the Pasadena market. Right? So let's say he were to get his license and he wanted to start appraising in California, and he lives 2 miles away from, Lake and Orange Grove.
Right.
Is he competent? Does he have the market experience? No. Right? Does Mike? Yeah, because Mike's actually appraised here.
Right.
There are appraisers that move,
mm-hmm.
right? They live in a certain area and then they've done all their appraising in that particular market and then they move.
Right.
So now let's say they're willing to drive 40 miles because they want to go to the market that they know. They know the agents in that area. They know the market experts and they're going to talk to them. Right? Case in point, people that appraise in Manhattan, Beverly Hills, Bel Air, they don't live there.
Right.
But they do all their work there.
Got it.
So it's really about where they've done the work and where they're competent to do it.
Got
right?
it.
There's this thing called USPAP, which is the Appraiser Bible. And USPAP says that as an appraiser, you are required to gain competency if you don't have it. Right? So let's use a green home, for example. When an appraiser first did their green home, they didn't have experience.
Yeah,
There were no green homes,
right?
So what did they have to do? They have to research. They have to talk to experts. They need to get the competency to do that green home.
Right.
Some appraisers won't do it. When we had the big REO bubble, very few appraisers had experience appraising the volume of REO homes and really understanding the impact that an REO has in a market. Right.
Right.
So in the beginning, there were a lot of appraisers that wouldn't do REOs. They were very afraid to do it. There's this whole addendum that they had to do that they weren't really comfortable with. But over time, obviously, 2009, 2010, that's all there was.
Right.
So guess what? They got competent.
Right.
So oftentimes, and I think just because the industry has been conditioned, when they see the mileage or the proximity of the appraiser, it's a really quick way for them to poke a hole in it.
Right.
Right.
Exactly.
And so for a long time, a lot of our customers had these really tight proximity requirements.
Yeah.
Well, that doesn't always reap you the best appraiser or the best result or the best quality appraisal. When you think of rural areas, appraisers drive 100 miles.
Right.
Right? So no, proximity,
unreasonable. Yeah.
proximity is not a measure of competency.
It also kills turn times in particular markets.
Yes.
If you're going to limit, if you're going to limit appraiser coming from 15 miles away, and all that every appraiser in that market is saturated, you're going to be waiting longer for a report.
Yep.
Absolutely. Right. And Ron, yeah.
Yeah, so what I've actually seen in a couple of the appraisal reports is when you have an appraiser in Brea and they're appraising a property in Pasadena, they'll actually put in the report that they have been in this market for the past 10 years on a weekly basis, appraising X number of homes,
their
just so that
competence.
Exactly.
Right.
Exactly. I think the biggest challenge comes into play when they miss something like the home is in a historic district or something that would, that just is something that's different than someone that was in Brea that may not know that, right? Okay. So the buyer, they could see that as something that they missed.
Got it. All right, guys. Well, the last thing I want to say is what's the deal with all these appraisers being musicians? Is this true?
I think it is true.
Really?
Yeah. Unfortunately, I'm not one. But yeah, there is a lot.
And Mike is going to play us out.
No, you don't want to hear that. Nobody wants to hear that. I don't know what it is about it, but there are a lot of appraisers. I mean, one benefit of being an appraiser is you get to listen to the music you want as you're in your car all day. But I don't really know why.
Interesting.
But it's true.
Oh, what a coincidence. All right. Well, very good. You have...
Well, I was just going to say a favorite line that people have is that appraisal is an art, not a science.
Yes, right.
So it could be that they're already predispositioned to be artistic.
Being creative. All right. But we don't want to be too creative, right?
No.
Well, Cindy, Mike, thank you so much. I mean, seriously, this has been incredibly educational, and I'm so happy you guys to be here. Thank you so much. I really appreciate it.
Thank you for having us.
If you guys have any other questions in regards to appraisals, we can definitely get in touch with Cindy and Mike. But do you guys have any kind of contact info you guys want to give anybody, or is it...
Well, you can find us at PCVMurcor.com or 888-623-4001.
Fantastic. All right. Well, that's about it for us today, too. If you have any questions or comments, please don't hesitate to leave them for us on our Facebook page, facebook.com/Clarified Realty Podcast, all one word. You can email me directly at tom@clarifiedrealty.com. For more exclusive bonus content and advice between episodes, please check out our website, www.clarifiedrealty.com. Also, on our homepage, you'll find links to helpful buyer and seller guides that can give you some great information for starting your home buying or home seller process. So definitely check those out. I'm on Snapchat, Twitter, and Instagram as well. My handle for all three of those are @ClarifiedRealty. I beg of you, please, please, please stop everything. Go and leave feedback and reviews on iTunes or in the comments section on my page. And my amazing theme song, Hey Now, is from the band Wolf. That's Wolf with 2 Fs. Please go check them out and like them on SoundCloud. We'll also leave a link to the song in the credits. They rock so hard, they're always guaranteed to appraise for higher than the list price. And just a little disclaimer, Ron and I are licensed by the California Bureau of Real Estate. My license number is 01715353. Ron's is...
Guaranteed rate, NMLS 2611, NMLS ID 558706, California.
The advice I give and Ron gives is only for properties located in the state of California. For all other states, please contact your local real estate agent or real estate professional. And that's about it. Ron, you good?
I am. Go Falcons.
Oh, wait a minute. I didn't say that. All right. Well, thanks for coming, everybody. And remember, the greatest thing you can ever do is make someone feel at home. Take care, and we'll see you next week.